we had to do a round two with Ferris on this Barita Brain Trust Bites, because not only does Ferris manage our local equity portfolio, but Ferris is also having his hands in the international equity portfolio, right?
That's correct.
And I don't know for you as a client, as I think about equity in the international market, honestly, you can feel a bit overwhelmed. There's millions of stocks out there, a lot of things that come in and out. How are you going to really benefit from this international equities market? What would you be saying to a client the best way to get into that?
Yes, that's a very good question, Sean. Of course, I mean, when you go out there in the foreign markets, there are so many options, and the question is, what should I buy at what point in time? You know, that's a lot of hassle for the individual investor. So we have our FX growth portfolio, and that's primarily invested in the international market. So you get exposure to the foreign markets. So that's suitable for investors, rather, who would want to get exposure to the foreign market. They have hard currency. They don't want to convert to the local currency. I mean, we really don't have much of a problem in terms of the valuation, even though we're hearing noise these days, because the currency is supposed to move in both directions, right? So you want that diversification as well in the foreign markets. So we offer the FX growth portfolio. So it's suitable for persons who want to take on risk, right? The moderately aggressive to aggressive investor. And we sit down every day, we review the foreign markets, and we decide what assets to include in that portfolio. And it has done fairly well so far this year, over 14%. You know, that's a decent return.
And 14% in what, local dollar terms?
Oh, no, foreign US dollars.
Wow.
14% and it's tax free. So, you know, that's pretty good return for an investor. You know, so I think that people should consider diversifying their investments, and that they could add the FX portfolio to their investment option as well.
No, man, that's very good enough, Ferris, because as you mentioned, you know, there's a lot of things out there in the market. I kind of said to investors quite often, you're a doctor, you are a DJ, you are a videographer. You have time to really hone your craft. It's really difficult for you to now go and figure out what's going on in China, what's going on with trade war, what's going on in the United States, what's going on in Mexico, and all these things. What we really provide for clients in a fund like this is, again, the brain trust, putting in the work, going through all of the things going on in the market and saying, all right, there's an opportunity, there's an opportunity. So even like that, first, as you think about the international markets, where are some opportunities that you guys are looking at for the sake of the fund in general?
Well, yes, I mean, there are so many variables involved. As I mentioned, the trade war, and I think that's really the center of focus right now, or the focus point. Well, yes, so, I mean, that has been weighing on markets right throughout the year. It's a 50, well, not throughout the year, it's a 15-month trade war. And that has weighed on markets. It has dampened the global growth outlook. And the investors have been concerned, businesses have been concerned as well. So they have cut back in terms of spending. And that has caused investors, by extension, to panic and wonder whether or not there will be some slowdown or any recession. I mean, we saw an inversion in the yield curve, for example, a couple of times throughout the year, and people were wondering, boy, will there be a recession? Because in the past, I mean, when we've seen an inversion in the yield curve, that means, well, it has preceded recession. So
before
assuming,
you go forward,
yes,
there, just explain that in terms of the yield curve, just for listeners.
So yes, that's a very good question. So on a normal circumstance, when you talk about the yield curve, you're talking about different maturities in terms of fixed income investments. Now, the longer you go out into the return spectrum, you expect to get a higher return for putting away money that long.
That's right.
So longer term fixed income investments should provide higher yield. Shorter term, lower yield. So you'll see, as you mentioned, the curve, it's moving up. So what you have is a situation where people are expecting things to be negative
in
going
the long
forward.
run, right.
So it speaks to their expectation. And as a result of that, when it comes to long-term investments, they are buying those assets. And
That's
as a
right.
result of that, the prices move up.
Mhm.
And there's an inverse relationship or negative relationship between price and yield. So when the prices move up because investors are buying those assets, yield move down. Right. So, I mean, because of that situation now, the expectation is that you might very well see a recession. It could be a self-fulfilling prophecy as well, no? Because you have doubts. You stop spending, like the businesses have been doing.
Right.
So when you pull back, then you see a slowdown in economic activity, and then you have the recession, right? So that centers primarily around trade. But we're seeing some light at the end of the tunnel, in a sense, because the US and China, they have come up with this phase agreement where you have phase 1, 2, and 3.
Right.
And phase 1 is supposed to be completed by the end of this year. But they're having some difficulties in terms of fine-tuning what exactly should be in writing as it relates to the agreement. So investors are waiting patiently. But that is a major factor that has been affecting the market. So the question was, what are the opportunities out there?
Yeah.
Those sectors that have been exposed to trade tension between the US and China, they should recover or do well,
right,
because of the fact that we no longer have that challenge.
Right. And they would have come off in prices for the year. So yes, there's opportunity there.
Right. And you have cyclical sectors. Cyclicals, those sectors that will benefit from an uptick in economic activity, those sectors will do well as well. I would avoid energy. I've not been a fan of energy because of the fact that you have a general weakness in economic activity, and the main driver of oil is demand.
Right.
And the US has been increasing production, and they have been gaining market share. And you have seen the somewhat glut in the oil market, in a sense. Saudi Arabia, OPEC plus Russia, they have been cutting back in order to keep prices afloat. When you have, you will not, even though you have a resolution to trade of sort, you may not have significant uptick in the price of oil because of the demand may not follow immediately, right? So I would try to avoid that form of investment, even though it might be bottoming out. The manufacturing sector, for example, they have seen significant weakness there. I think that has been bottoming out as well.
Okay.
So there are signs that the economy is improving, US in particular. The Fed's Beige Book, they mentioned that they're seeing a moderate uptick in economic activity. So that suggests that things are improving in general, right? The consumer spending accounts for a significant portion of the US economic activity. Let us see what the Christmas holiday brings.
Right.
But I think that the spending has been slowing down somewhat. But that's the main driver. It has been holding up still. Consumer confidence is pretty high, even though it has fallen off a bit. But things on the balance are looking more or less positive, right? So investors can look at the consumer discretionary, and you can also look at the technology sector. That sector should benefit from a better relationship between the US and China.
That's true. And Ferris, again, thank you for just the sort of insights that you're trying to bring, just not to our funds, but to our listeners here, because again, we want to remind you, there are opportunities. There are opportunities internationally, and really the best way to really capitalize on something like that is benefiting from the brain trust that we have here. We are able to comb through these opportunities and really ensure that your funds and your money is continuing to work for you.